Good afternoon, everyone.
Good
Thanks
afternoon.
for joining us today. Today, we're very lucky to have Anthea Perkinson to talk about doing your tax returns, Tax Returns 101. Anthea is the founder and principal of Monterey Associates, an independent advice-only financial planning firm serving clients in the New York City and Westchester area.
Thank you very much, Matthew. So I am going to give you an overview of the current tax law, and this will help with the preparation of your 2025 tax return. Simple agenda. I'm going to explain the concepts of above the line and below the line and how the IRS 1040 flows. Once you understand that, tax planning and tax saving strategies become a little bit easier to understand. I'm going to go over very quickly what the Tax Cut and Jobs Act was and what has changed with the new One Big Beautiful Bill Act, which is the current tax law, went into effect for tax year 2025. And it's got a bunch of different sunsets, which I will point out as we go through some of the deductions and credits that have been introduced. Then, to pull this all together, I'm going to give you two senior New Yorkers case studies using the 2025 tax return, what they do and what makes sense for them that may help you better understand the current tax code. So, how the IRS 1040 form flows. I've heard multiple CPAs give presentations about doing tax returns. And I heard one very memorable one say there are above the line adjustments and below the line deductions, and these represent two different sandboxes for tax preparers to help their clients save on income tax. So, what does that mean? There are two major calculations that are done in preparing a 1040 IRS 1040 tax return. Step one is to document and include all forms of income, known as gross income. Then you either add additional forms of income that we may forget about, less common, or we subtract, which are called less adjustments to income. And once we've done these two calculations, plus or minus, we have adjusted gross income, a really meaningful term in US personal finance. We're going to come back to why that's so important to know what our adjusted gross income is. But once we've gotten here, we've only done the above the line adjustments. Next, before we can even calculate our taxes, we have to take adjusted gross income and subtract either the standard deduction or itemized deduction. This is below the line. And only here do we get taxable income. So there are a few steps. We'll go through it. We'll return to this concept as we go through the tax code. Highlights of the Tax Cut and Jobs Act, which was passed in 2017. Major changes to the tax code. The whole initiative was supposed to simplify it. It really didn't. And it was in effect for 2018 through 2025. What was significant about the changes, there were new tax brackets, many more of them, starting with lower rates of tax and going to higher rates of tax. And I'll show you what these are presently. Introduced a new higher standard deduction amount. Many of us have been around long enough to remember that prior to 2018, the standard deduction was not a lot of money. What you did, in addition to taking the standard deduction, is that you claimed certain exemptions. So personal independent exemptions. And you may remember from taking a new job or going in at the beginning of the year, filling out a W-4 form to indicate how many dependent and personal exemptions you wanted to do. If you took no exemptions, or maybe just one for yourself, you were taxed heavily. More federal income tax was taken out of your paycheck, and you could, actually, the reverse is true, forgive me. You were taxed lightly, and they just took enough to represent you as the exemption. And at the end of the year, you would probably owe income. No, you would get a big refund. If you claimed a lot of exemptions, they didn't take any tax out of your paycheck. So you then had to file your taxes and pay the difference. So this allowed some people to use their tax refund as a sort of savings vehicle. They would file and get a big tax refund, and that's how they forced themselves to save. It also allowed others to have a lot of, not enough tax taken out, and as a consequence, for them to pay a big tax bill come April 15th. It is much more a pay-as-you-go system. So they eliminating these exemptions makes this pretty apparent. The other new item introduced was the SALT cap. This stands for state and local taxes. It used to be you lived in the tri-state area, and you paid big property tax, you paid New York State income tax, you paid New York City income tax, and you were allowed to claim all of this as you itemized your deductions. Then it really reduced how much you paid in federal income tax. So a cap was instituted, $10,000. That's as much as you can deduct for all of those state level and property taxes that you are paying. This resulted in significant tax increases for certain segments of the population. Another interesting feature was a cap on deductible mortgage interest. You could deduct all of it on multiple homes, and that was just commonly done for those who itemized. Other interesting feature of the Tax Cut and Jobs Act was qualified business income, which basically allowed certain businesses, mostly small businesses, service providers, etc., to get kind of a standard deduction before they paid taxes on business income. It's referred to as QBI. There were more changes in 2019 when the AMT was adjusted for inflation, and then other changes in 20 and 21 due to COVID. So let's talk about the current tax code, OBBA, which is now referred to as OB3, which is a lot easier to say. It calls the higher standard deduction amount permanent. Now, accept that with a grain of salt. Nothing is permanent in the tax code. It's a law passed by Congress, approved by the Senate, goes through reconciliation where the House version and the Senate version are made uniform, then presented as a bill to be signed by the president. Then the IRS is the enforcing entity. They enforce the law. So nothing is permanent, but for at least the next 4 years, the standard deduction amount may be adjusted for inflation, but for a single individual, $15,750. For married filing jointly couple, $31,500. Pretty significant standard deductions. Remember, if you are over age 65, you get to claim an additional $1,600 if you are each married, or if married, each of you gets $1,600. If you're single, it's $2,000. This is for the blind or over age 65. Additionally, there's a new $6,000 deduction for filers 65 and over. I'm going to give you more detail on that. The other thing claimed as permanent are these new tax brackets, the 10, 12, all the way up to 37%. There's a new deduction for reported tips and overtime income, a new deduction for qualified overtime pay, new temporary increase in the cap on state and local taxes. The SALT has gone from $10,000 to $40,000. There is a new estate and gift tax exemption set at $15 million for single filers, $30 million for joint married filing jointly. Goes into effect for 2026. So right now, this is in effect. And here again, the $6,000 additional deduction for filers age 65 and over. Let's look at in a little bit more detail how some of these may impact you. This one is very interesting. The deduction for reported tips, and these are for jobs where tipping is customary. You are a server, you are a theater usher, you are a masseuse, you ordinarily receive tips. You work in a bar, that sort of thing. We can't call fee income tips. So it's regulated that way. This is an above the line deduction. So by separately reporting your tips up to $25,000 per year, it's going to show up on box 7 of your W-2. It reduces your adjusted gross income. That's pretty meaningful. There is a phase out, and a phase out means that at a certain level of income, this deduction is no longer available. So the phase out begins at $150,000 for single filers, double that for married filing jointly, and it goes down by $100 for each $1,000 that you're over that $25,000 max. Tips are still subject to FICA and state taxes. This only applies for federal income tax, but it could be meaningful. Qualified overtime pay deduction. This is only in place for years 2025 through 2028. And this does not apply for collective bargaining type jobs. So if you belong to a union, it's very unlikely you're going to see this. But if you have a job, and a typical example might be somebody who works as an administrative assistant and in an office for that kind of capacity, where if they work more than 40 hours in a week, they're eligible for time and a half. It is only the half that is the qualified overtime pay deduction. So for example, if your regular rate is $20 an hour, and when you do time and a half, you get 30, only that $10 is the qualified overtime. This is a below the line deduction. It's a max of $12,500 per tax year. Double that if you're married filing jointly. It too has a phase out. If you're single filer, it's $150,000. If you're married, it's double that. Still subject to FICA and state income tax, but it is available to standard and itemized deduction returns. Okay. New state and local taxes, the SALT deduction. This too, limited availability, only in tax years 2025 or tax return years 2025 through 2029. It is a below the line deduction, so only for those who itemize. It is a cap of $40,000. It'll have an annual inflation adjustment. It reverts to $10,000 in 2030, and there is a income threshold. So the phase out is not even a phase out. Once you hit $500,000, there's a big reduction in it, and essentially you get pushed back to $10,000. So whether you're a single taxpayer or married filing jointly, that income threshold, adjusted gross income over $500,000, you're pushed back into the $10,000 cap. The senior deduction, this is a good one. It is available as highlighted to standard and itemized deduction returns. It's only available for tax years 2025, so the tax return we're preparing now, through 2028. It is a temporary deduction of $6,000. It is above the line. No, that's not true. This is below the line. Forgive me. Strike that. It is below the line, additional $6,000 per year. There is an income phase out. If you earn if you have adjusted gross income over $75,000 as a single filer, it reduces this. $6,000 goes down, and $150,000 if you're married filing jointly. Once you reach adjusted gross income of $175,000 as a single, or $250,000 married filing jointly, it's completely phased out. You don't get this benefit. Repeals made permanent. I mentioned this before. The personal exemptions, those are gone in favor of the higher standard deduction. Home equity interest, home equity debt interest deduction, that's gone. It used to be, even through the Tax Cut and Jobs Act, that if you used a home equity line of credit or loan to make improvements or repairs on your primary residence, you could deduct the interest, no more. Moving expense deduction only exists for members of the military. Other lower limits made permanent, you can deduct home mortgage interest if mortgage balances add up to less than $750,000. So for the most part, it's eliminating many people who take out jumbo loans. They will not be able to deduct their interest until the balance falls below this threshold. Personal theft and casualty loss used to be able to deduct this. Now, only if there is a declared federal or state disaster, which means that it's almost exclusively for natural disasters, floods and fires, etc. Charitable contribution deductions. So starting in 2026, so next year when we do our tax returns for 2026, individuals who do not itemize can deduct charitable contributions made in cash only during the year. It's below the line, so it affects taxable income for non-itemizers. There's an annual max of $1,000 given to charity, single filers, $2,000 for married filing jointly. For those who itemize, they're instituting a hurdle, a threshold over which your charitable contributions are deductible. So you have to calculate 0.5% of your adjusted gross income. And once you have that number, only the charitable contributions in excess of that amount are deductible, below the line. Allowances made permanent. Mortgage insurance is deductible. It's now called qualified residence insurance. Child tax credit, the base credit is now $2,200. It's going to be indexed to inflation. It is refundable up to $1,700 for 2025, and this amount will go up with inflation. The cap on other dependent child is $500 for this year, and there are child tax credit income phase-outs, and these are now considered permanent. For single tax filers, if you make more than $200,000, you don't see this benefit. And for married filing jointly, it's double that amount. Other provisions, car loan interest deduction is very specific. It's not going to impact that many people. Trump savings accounts, these are beginning to be made available. We'll see how that goes. And then this is an interesting feature. 1099 reporting thresholds. If you do work as an independent contractor, used to be that if you made more than $600, the hiring entity had to send you a 1099. Now that amount is $2,000. You as the recipient still owe income tax on that, but they're not obligated to give you a 1099 unless they're 2,000 or over. So again, here we are with our above the line gross income plus or minus adjustments to income, getting to adjusted gross income, and then below the line, taking adjusted gross income, subtracting either the standard or itemized deductions to get to taxable income. So, who uses AGI? Why is this such an important term? Most benefits provided to taxpayers of any age by the state and federal government, tax credits, eligibility to make direct Roth contributions, Medicaid eligibility, state and federal income-based benefits, school lunch, SNAP, housing, FAFSA. All of this is based on adjusted gross income. Not your taxable income, not your gross income, but your adjusted gross income. For seniors over age 65, the Medicare premium surcharge, income-related Medicare adjustment amount, IRMA, the dreaded IRMA, depends on your adjusted gross income. The New York State Senior Citizens Housing Exemption Program, the property tax abatement, depends on your adjusted gross income. Enhanced STAR, which is a school tax abatement, depends on your adjusted gross income. So there are a lot of reasons to pay attention to that very important number. What's income is subject to tax? Income earned from work, referred to as earned income or ordinary income, or from investments, which is referred to as passive income. Social Security and pensions are subject to tax as well. Whether you're paid by check or cash, it's taxable. Whether that your employer reports it to the IRS or not, it's taxable to you. Whether this income is from foreign or US sources, there are people who are being paid for work here by foreign companies, that's subject to US income tax. And from legal or illegal activities. I have a picture here of Al Capone. You probably heard about him or seen him in the movies. Famous bank robber from the 1920s and 30s. They never caught him for bank robbery. They caught all of his associates who actually robbed the banks, but he was the mastermind. They raided his office and home. They discovered all of this money that they suspected was from robbed banks. And when he couldn't prove that he had paid income tax on all of this money, they charged him with tax evasion, which is a federal crime, and he went to Alcatraz, very famously. All right, so what counts as income? This list comes directly off the IRS.gov website. It includes W-2 earnings, net of tax-deferred employer savings plan contributions. So that's your 401k. Obviously, if that's pre-tax, that's not included in your current taxable gross taxable earnings. 1099 miscellaneous for contract work, 1099 div for dividends and short-term capital gains from your investment accounts, 1099 int from your bank for interest you've earned. Unemployment insurance is taxable. Withdrawals from traditional IRAs, 401k, 457B accounts, etc. Distributions from pensions and annuities, Bitcoin and other virtual currency used as payments for services. This is a question asked now and has been for a few years on the IRS 1040. Do you own Bitcoin? Were you paid in Bitcoin? Capital gains, short-term or long-term. Gambling winnings, whether you play the lottery, sports betting, event betting, in the casino, gambling winnings are income that has to be declared. Gains from the home of a sale or apartment in excess of the exclusion amounts, which are different for single and married filing jointly. For a given debt in excess of $600,000 or $600. Jury paid duty, which is annoying because you get paid for serving on the jury, but you don't get a 1099 or any kind of W-2 at the end of the year, so you have to remember and declare it. If your tax refund is held up for any reason and the IRS pays interest in the following year, you have to declare that interest as taxable income. Just to remember, with respect to gambling winnings, and a lot of people are now gambling on their phones throughout the day, under the One Big Beautiful Bill Act, 90% of gambling winnings can be deducted, right? So even if you lose money, you have to, it's not letting you offset 100% of your losses. So you have to pay income tax on at least 10% of what you won, even if you have a lot of losses. So it's a threshold. Where do we report this additional income? The IRS 1040 Schedule 1. So here's where we report our taxable refunds, offsets, etc. Alimony received, business income. Maybe you have a little personal business you sell handmade items, etc. You figure out the tax you owe on Schedule C, which allows you to deduct your expenses, and you'll come to either a net loss or a net profit. Then you transfer that figure onto Schedule 1. If you have rental real estate, receive royalties, partnership incomes, S-Corp income, etc., you report that on Schedule 1. Unemployment compensation, gambling winnings, canceled debt, etc. So all of this sort of random sounding sources of income gets picked up on Schedule 1. There are adjustments to income. I mentioned that there are some things we can do that reduce and get us to adjusted gross income. Number one would be a traditional pre-tax IRA contribution. If you're over age 50, you can put up to $8,600 into an IRA provided that you have earned income of at least that amount. If you're a teacher, you can deduct educator expenses on Schedule 1. If you make health savings account contributions, you have to be younger than age 65, not on Medicare, but that too would be indicated as an adjustment to income on Schedule 1. Here again, a traditional IRA contribution requires earned income from a job or a business, but no longer is there an age limit. This changed under the Secure Act. And if you're under 50, you can contribute up to $7,500, provided you've earned at least that amount, and $8,600 over age 50. And you can make these contributions into a traditional IRA up until April 15th and claim it on your 2025 tax return. All right, so let's look at an example to put this all together. So we have Tina, taxpayer. There's a picture of her. She is a college professor. She enjoys her work, finds it very stimulating. In 2025, she had W-2 earnings of $72,535 after contributing to her 401k plan, about $8,000. She received a 1099 div from her brokerage account and a 1099 int from her bank, total of $1,019. The div actually represented capital gains, long-term capital gains from sales of PNC bank shares. The $19 was regular bank interest, ordinary income. She received some royalties for sales of a textbook that she was an author of. So her total gross income for 2025 adds up to $74,154. She also made a traditional IRA contribution of $3,000. That's her only adjustment to income. So now her adjusted gross income, $71,154. So the next question, we've done above the line, getting her to AGI, adjusted gross income. Next step is below the line. Should she take the standard deduction or should she itemize her deductions? Let's look and see. Remember, here's where we are. We're going from adjusted to taxable income, below the line. Standard versus itemized deduction. Remember that if she takes the standard as a single person, it would be $15,750. Since she's over age 65, she's 66, she gets either $1,600 if she's married, $2,000 if she's single, and she gets the OB3, $6,000. She's well under the income threshold. If she were to itemize her deductions, she could deduct up to $40,000 on any income taxes she's paid to New York State, New York City, or any sales taxes she's paid on any large purchase, property taxes, the SALT taxes, she's got property or school taxes, so that's a pretty good cap. Medical expenses. She can deduct medical expenses that exceed 7.5% of her adjusted gross income. She can deduct mortgage interest for up to 2 homes, provided the balance is under $750,000 on the mortgage. If she's paying PMI, private and mortgage insurance, she can deduct that. And charitable contributions up to 60% of her adjusted gross income for cash contributions, 30% of adjusted gross income for non-cash, meaning giving away clothes and housewares. All right, so let's look at her situation to figure out whether she'll take the standard or itemize. Well, she lives in a rental apartment, so there's no mortgage for her to deduct interest on. She did pay New York State and New York City income taxes of $6,035 combined. She had some medical expenses out of pocket, $3,300. Anything deductible? Well, 7.5% of her adjusted gross income, $71,154, would be $5,337. If we subtract that amount from her, what she spent out of pocket, it's a negative number. So there are no potentially deductible medical expenses. She did give money to charity, added up to about $1,800. So when we look at her eligible itemized deduction, we get to 7,835. So of course she would take the standard deduction. She would subtract 15,750 plus 2,000 plus 6,000. And from her adjusted gross income, her taxable income becomes $47,404. Now we can figure out her tax bill. We've gotten to taxable income. Let's look at the tax brackets and rates. So ordinary income, earned income, interest from your bank, short-term capital gains, and dividends are subject to the income tax brackets and rates on this chart. You can see for single filers, you pay 10% on the first $11,925 in ordinary income. The next bracket goes to 48,475 at 12%, 22%. You can see that these brackets widen as we go. So more and more income fits inside. And then there is a top maximum tax bracket, which covers any and all income, taxable income over $626,000. Notice that there is a separate tax schedule for long-term capital gains for asset sales. What would asset sales include? Well, for long-term asset sales, stocks, bonds that you've owned for more than a calendar year, sales of homes and apartments, sales of antiques, sales of land. These would be subject to long-term capital gains. Here's how this works. If her taxable income, which we know is 47,404, falls under this bracket, 48,350, she pays zero on her long-term capital gains. If it were to fall, if her taxable income fell here, 48,351, all the way up to 533, she would pay 15% on that capital gain. So in her situation, her 1099 div included a $1,000 long-term capital gain from selling those bank shares. Given her taxable income of 47,404, 46,404 is taxed at ordinary income rates over here, and that $1,000 that she made from astutely selling those bank shares is taxed at zero. This is why Warren Buffett famously commented that he pays income tax at a lower rate than his secretary, because all of his secretary's income was ordinary income, subject to these tax rates, whereas the majority of his income was long-term capital gains from his investments. So he paid at a lower rate. Here's how to think about this. When we figure out our taxable income, think of it as ordinary income is like water poured into a bucket. Long-term capital gains, think of it as oil. When you pour water and oil into a bucket, the long-term gains, the oil will sit on top. If you have more water than oil in the bucket, you will push your long-term gains into a higher long-term gain tax bracket. That's how you go from the 0 to the 15 up. If you have less ordinary income, less water, you pay lower rates on those long-term capital gains. So to the extent that you have long-term capital gains in a given tax year under the current tax code, you want to minimize your ordinary income to lower your effective tax rate on those gains. Okay? Two important terms that I want you to understand. I hear even tax people use these incorrectly, confuse the two, and that's not helpful. Ignore the dollar amounts and the tax rates here. What I want to illustrate is that the tax margin, the marginal tax rate is the highest bracket your income penetrates. So in this case, if your taxable income is $50,000, your marginal tax bracket, this money in here, is taxed at 22%, and you could fairly say you're in the 22% marginal tax bracket. Is that your effective tax rate? No, not all of your money is taxed at 22%. Most of it is taxed at 12. Some of it is taxed at 10. To understand your effective tax rate, you take your total tax bill and you divide it by your gross income, pre-tax. We're going to look at Tina Taxpayer and illustrate this exactly. So here we have her $47,404 taxable income, including that $1,000 long-term capital gain. So on her first $11,925, how much is taxed? All of it. She owes $1,193. The next amount in this bracket, her income at $46,404 falls below 48. $34,478 is taxed at 12%, giving her a bill of $4,137. She's in the 12% marginal tax bracket. She's got nothing taxed at 22%. She pays zero on her $1,000 long-term gain. So her total federal tax bill for 2025, $5,330 on taxable income of $47,404, gross income of $74,154. She's in the 12% marginal tax bracket, but her effective tax rate after the deductions, after her standard deduction and her two senior deductions, it's a pretty fair effective tax rate, 7%. Okay. Let's look at another individual. Slightly different situation. He's 67. He's a retired New York State employee. And from New York State, he worked there long enough to collect a pension, but it wasn't his whole career. He spent time before working for New York State, working for New York City. If you're a New York City employee and you contribute to one of their retirement savings plans, you can elect not to contribute to Social Security, which is why he has a rather modest Social Security payment. So he's got a pension. He does some part-time work this year. He's not been retired that long, still likes to keep his hand in. He started his Social Security when he turned 66. He took out $55,000 from his 403B plan. This has been a big year for him. He's done some renovations to his apartment. He's bought some new furniture. He took a cruise. He's enjoying himself. He says, while I'm in good health, I want to make sure I do this. He had some taxable interest, not much, $63. So his gross income for 2025 adds up to $118,519. He's got no adjustments to income. He didn't make an IRA contribution for his part-time work. He's not eligible to contribute to a health savings account. So his gross income is effectively his adjusted gross income. So next we want to know, does he take the standard or itemized deductions? Well, he owns a condo in Long Island City. He's got a property tax bill of $7,750. He did pay a mortgage interest of $22.24. He did pay income tax, New York State, New York City income withholding. He's had this withheld from his pension and his part-time job and his 403B withdrawals. He did have some deductible, well, does he have some deductible medical expenses? Not really. His threshold, 7.5% of his AGI, which is 118, not 121. That would be a $16,000 threshold, so he doesn't have that to deduct. He only paid the standard Medicare premium, $185 for Part B and $37 for Part D. So no medical deduction amount. His eligible itemized deductions add up to $18,408. So he would itemize $118,000 minus $18,409 plus the $2,000. he's single, plus the 6,000, the new senior deduction under OB3, gives him taxable income of $92,100, $110. Let's do a quick calculation of his tax bill. He too fills the 10% bracket and owes $1,193. He fills all of the 12% bracket, $36,519, so that's $4,386. He goes into the 22% marginal bracket. Certainly didn't he didn't fill it, but he does have to pay 22% on $43,624. So that's a bill of $9,599. Nothing in the 24% bracket. So his total tax bill comes to $15,178 on taxable income of 92, gross income of 118. He's in the 22% marginal tax bracket, and he's got a 13% effective tax rate. Now, he's in trouble in 2 years. So he files that tax return, pays this amount for the year. What he's not thinking about is that he is going to be subject to IRMA in 2027. You can look up what the threshold is. The threshold for a single taxpayer to be subject to IRMA is $111,000. We don't know what the rate will be, but if his AGI is 118, he's going to be paying this, paying extra for his Medicare basic coverage. So what can we do for him? What if we recommend to him that he makes a traditional IRA contribution? Put in the full amount that he can. He's got the income. He's got earned income of $10,500. He can take this money out of savings. He can put in $8,600. Now his AGI is 109,919. So he avoids IRMA in 2027. And you have to think forward 2 years. It's kind of a maddening system. He's also, once we back out his retirement account withdrawals, his adjusted gross income in the eyes of she is $54,919. The SHE program, Senior Citizen Housing Exemption, excludes retirement account withdrawals. So they take federal adjusted gross income minus retirement account withdrawals, and they look at that, and according to their schedule, he would be eligible for a 20% reduction on his real estate bill, which is pretty significant. A reminder, the SHE application is due on March 16th, 2026. If you're going to use your 2025 tax return, you've got to get that done quick. What is a tax credit? Just want you to understand what these are. It is taken after the calculation of the taxes you owe. So it reduces your actual tax bill. This is the last thing that happens, generally calculated by software. We don't see this because it's too complicated to do by hand much anymore. But it reduces the actual tax you pay. It's included in the tax code to incentivize certain behaviors. So we have the American Opportunity Tax Credit, which is up to $2,500 for people who pay college tuition. We have energy efficient tax credits if you replace your window, your boiler, etc. Electric vehicle tax credits. This is the last year that they're around. The Savers tax credit, if you are of modest adjusted gross income, you will get a tax credit if you make a contribution into an IRA, traditional IRA. And then, of course, the child tax credit. If you are raising children under the age of 17 and are of modest income, you can take a credit. The credits come in 2 flavors. Refundable, meaning that if your tax bill is smaller than your tax credit, you will be refunded the difference. Non-refundable tax credits mean that your tax credit will offset your tax bill if it's larger than your tax bill, but they won't send you what's left over. You don't get the refund. So looking at the child tax credit, the credit actually was raised to $2,200, children 16 and under. It's still $500 for other dependents. It is partially refundable. Okay, it's going to be $1,700 refundable, indexed for inflation 2026 and beyond. There's a phase in. You have to have some level of earned income to be eligible for this, and there's a phase out. These are now permanent, 400,000 for joint filers, 200,000 for single filers. It's a pretty significant credit, particularly for moderate income people raising children. There are requirements who qualifies for the tax credit, indicating the age, the dependency, financial support, citizenship, etc., all up on the IRS website. Now, I want to show you a couple of slides and encourage people to explore doing their taxes on their own for free. If you have adjusted gross income below $89,000, you can go to irs.gov, free file, and look at all the providers for free guided tax software. Guided means it asks you a question, you answer the question, behind the scenes it fills out your tax form. And at the end, you're able to file. These are the first 4 of the tax software providers that offer free tax preparation. And you have to look at each of these to make sure you qualify. Since we live in a triple or at least a double tax state, federal taxes, New York state taxes, if you live in New York City taxes, you want to make sure you can do your free state tax return. Here are the other 4. I've used this one with my nephew. It's very straightforward. Generally, it pretends like it's going to charge you for the state tax return. Ignore that, keep going. If you're eligible for the free federal, this is free too. Works just like TurboTax. It allows you to enter your checking account to have your refund deposited directly. If you owe money, you can have it ACH'd with your tax return. You can save a PDF, print it out, and you can keep an account or not for future years. Very simple. Okay, so this is tell us about yourself. We can all answer these questions. Nothing gets too hard. It will tell you what box to look at on a W-2, etc. And there are help buttons if you need, and you can go backwards, you can start over, etc. This is our OB3 tax return. It is a monster. And so it is not advisable to try to pencil your way through this. I think it's advisable to work with software, and you could either try this on your own, IRS free file, or you can call 311 if you're in New York City, ask for a VITA, Volunteer Income Tax Assistance, location near where you work or live, because this is a fairly complex form. And what's not visible here is the Schedule 1A, which also has to be completed. So it's a monster. Tips, tools, and resources. VITA return prep. Here you can get help. Call 311 for locations. As I said, try the IRS free file. Maybe you want to try that first, see how well you do. If it's too much, you can go to VITA rather than pay to have a simple return prepared for you. For the SHE information, Senior Citizen Housing Exemption info, Department of Taxation and Finance.gov, or you can go to just www.tax.newyork.gov, and then they have a search, look for senior exempt, and you can find the application. It's all done online. And if you're going to use your 2025 tax return, make sure that's already been filed or filed before you apply. You can also use your 2024 if that helps you get a better deduction. And at this point, I will take questions. All right. Do employers have to report to IRS contractor payments under $2,000? No. They don't have to produce the form, and so it's not being reported to the IRS. It still could come up if they are audited. So if you're being paid less than $2,000, even though if you don't get the form, you should declare the payment on your Schedule 1A. In the President's
But
State of
just
the
to be
Union,
clear, your chances if you don't are less than they used to be.
correct, but this is true. However, if the employer is audited, which could
Yeah,
happen,
yeah,
it could be found out, and then you'll get a letter.
right. Okay.
In the President's State of the Union, he said there was no taxes on Social Security. Is that true according to what you said earlier? It is not true. There are taxes on Social Security for most individuals. If you earn over a certain amount, the amount is very low, 85% of your Social Security earnings are taxable. The $6,000 special deduction for seniors was the make good on this promise. So it's unrelated to whether or not you're receiving Social Security, because you would get that even if you decided to claim Social Security at age 70. You still get the 6,000 deduction. When he could not keep that promise, this is what was developed instead. It will probably honestly help more people.
And the related question, I know some states do not tax Social Security. Does New York tax Social Security?
New York does not tax Social Security.
Okay.
That's at the state level.
Yeah.
You're still claiming it on your federal tax return.
Yep.
Is the AGI, adjusted gross income, for single or married for use of guided tax software? Yes. Yes, they're looking for your adjusted gross income. And so what you would do, your adjusted gross income on your 2024 tax return is roughly line 11. It's all typed so small, but you can find it. And if your AGI from 2024 met the requirement to use the free software, and this year's income is roughly the same, then you're in good shape. If you don't do a tax return, what do you need for the SHE application? I'm glad you asked that question. There's a worksheet on the website, and you can look at that worksheet either at the New York State Department of Finance or the New York City Department of Finance, or you can call 311. They can help you find it on the city website. And there's a worksheet you use, and they ask you to write down your sources of income if you're not a tax form filer. So you're certainly eligible, but you just have to prove your income or lack of income a different way. Is SHE only for the city? No. I did a presentation on this last March, and it is a New York State program. But what you have to do is look on the state website and then check your local tax authority to find out how they count income. So for New York City, there's a certain set of rules, and they deduct for New York State, you deduct the withdrawals from retirement accounts. So if most of the money you spend is coming out of a 401k plan or a traditional IRA or a 403b plan, and you have that maybe in a little Social Security check, you would probably qualify for a pretty significant percentage abatement on your property taxes.
I have a follow-up question before you move on to the next question.
Mm-hmm.
If you use a paid tax person, they just can't check a box that, yes, I want the SHE discount for people over 65. You have to apply for it.
It's a separate application. It's a separate application run by New York State. So you're doing your federal taxes, and that's over here. And then you want to take that federal tax return. Your federal adjusted gross income is the starting point for the SHE application. Then you deduct your any withdrawals that have come out of a tax deferred retirement account, traditional IRA, 401k, 403b. That determines the she adjusted gross income. Mhm. And the application, you can do it. There are paper applications if you're more comfortable with paper, but it's advisable if you can. There's an online application. So you can just fill it out. It asks the question and you fill it out and then you hit the button and it goes to them for review. And you'll get a response, whether you're approved and what amount you're approved for, or they'll tell you you're ineligible. And that will be sent by letter. Okay.
And that will affect the amount you might owe on state income taxes?
It doesn't impact your state income taxes. The way she works, if you own your house or apartment, and this works for even multiple family dwellings of up to 3 units, you're paying property taxes. And if you are income eligible, say the maximum amount you can get off your property tax bill is 50%. If you have she adjusted gross income of less than 58,000 for the year. What they do is they take the value of your property on the tax roll and they divide it by 2. They take 50% of that. That is now your property value according to she, and you pay income tax at your existing rate, but on that lower value, that half off value. Mm. So you can get a discount of 10, 20. There's a scale depending on how much your she income is. The max is 50%, which can save people a lot on those property taxes. It's not attached to the property. So if you were to sell your house and move away, the next owner does not get she. This only applies to the individual who's living in the house and owns it, and it's their primary residence. Those are great questions. Are estate planning services tax deductible? No. I do not believe there's no place to deduct that I have seen. If you're married filing jointly and one person is 65 and over, but the other is not, do the advantages apply like the 6K deduction? The one person gets the 6,000 on the IRS 1040 and the other person does not. So that would be fair. Okay. Next question. Would someone applying for she right now use their adjusted gross income from their 2025 tax year or their 2024 tax return? This is a great question. And the answer we got talking to the representative from the New York Department of Finance is that you can use the return for first-time applicants. You can use the return that works best for you, but it has to be a filed return. So if your 2024 adjusted gross income was lower for some reason than your 2025 will be, use 2024. You have to do income verification every 2 years, which gives you a little bit of an opportunity to do some tax planning, what that future AGI might look like. But we were told that they'll accept whichever return is filed that you submit on an initial application. And how are rewards to World Trade Center survivors given in the victims' compensation treated in terms of taxes? That's a great question. I do not want to give you a direct answer because I haven't looked at that one specifically. There are some types of rewards like this, legal rewards that are tax exempt. There's some that are taxable. So there, I would either look at a past tax return to see how it was treated or check with a tax provider. The VITA folks would know this answer as well. What is the American Opportunity Tax Credit? It is designed for taxpayers who are paying college tuition for themselves or for dependents. It's a $2,500 partially refundable tax credit, and you can only take it once during a 4-year college degree.
Thank you, Anthea, again, and thank everybody for tuning in to LifeView at PSS. Thanks again. Thank you, Anthea, and we'll see you next time.
Thank you.
You.